Pensions Part 2, what you should do with your pension in retirement. So this is a follow-up to video 1, Pensions Part 1, what you should do with your pension while you are working. Just to reiterate, there are very few people who are Gen X and younger who have access to pensions. They really are going the way of the dinosaur. They really are the domain of baby boomers and silent generation. And I unfortunately don't think pensions are going to make a comeback for millennial or Gen Zers. But 14% of Generation X has access to pensions. And at retirement, you need to do these things with your pensions. First, probably anywhere from 9 to 6 months before you retire, you're going to receive a packet in the mail from your pension systems. And there's some really, really important information in that packet. That's the time that you really need to sit down with the financial advisor and go over your options. They are going to send you a bunch of options, and you want to make sure that you select the correct options. Options can include everything from just a lump sum cash payout to a lifetime pension to a 20-year certain pension with beneficiary rights. There's a bunch of really important information in there, and they really do require some fine calculations to determine which one is right for you. Depends on age, income, risk tolerance, where you're living, if you're married or not, or have beneficiaries. Once you receive that packet in the mail, you should have a relationship going with a financial advisor who can help you interpret that packet and to make the best decisions for yourself. So another thing that you want to take into consideration, exactly who is managing your pension, who's in charge of that pension system. You often can find out the names of the board members and look into their backgrounds. Ideally, you would want your board members to have some sort of investment experience or were either pension recipients or once in the working system, but you want somebody who has investment knowledge, who is part of that system. And I say that because there's been some pension systems that have recently fallen into distress. And one of the reasons that was cited for the pension system potentially going belly up was quality of investment selections. And what was highlighted was that the board that was selecting these investments just wasn't really qualified to do the work. They didn't have anyone who had any sort of investment experience, and ended up selecting investments that were outside the range of risk tolerance that would be suitable for a pension. And the investment went belly up and caused part of the pension to become insolvent. So the quality of who is on the board and who is making investment decisions really matters with your pension. And I've had some clients, we were trying to determine whether they should take the lump sum payout or whether they should just take the lifetime pension. And the decision hinged on who was on that board. We were able to look up the board members and realize that nobody on that board really had any sort of investment experience and knowledge, and prior board members really didn't have any investment experience and knowledge. And based on that decision alone, the client decided to take the cash payout because they really were uncertain about the future of that pension, because pensions have to be highly managed, and they're often managed by institutional investors, but there are often selections made by board members. And if you're not confident in the board, it really can impact your pension. Number 3, and I mentioned this in part 1, but this is super important. Does your pension integrate with Social Security? And when I say integrate with Social Security, there are certain state pensions where if you receive a state pension from, let's say, Louisiana, the money that you receive in a state pension from Louisiana would draw down the amount you would receive in Social Security. So you can't, in essence, receive Social Security and pension at the same time. And this had to do with a decision made decades ago by certain states to kind of pull out of the Social Security system. This is a big deal. This is a big deal. And you don't want someone figuring this out 5 minutes before they retire. They should know this years, if not decades before they retire, that their pension does not integrate with Social Security. So they cannot collect their pension and Social Security at the same time. It's really going to be one or the other. And this can be a really unpleasant surprise for people who don't know that this is a thing. Certain states do not integrate with Social Security. California, where I live, I do a lot of pensions out of the state of California. A lot of the pensions don't integrate with Social Security, so you can collect your pensions and Social Security. But if you have a pension coming out of another state, you really do need to look into that well before you decide to retire. If you can collect your Social Security and your pension, do you have enough credits for Social Security? A lot of people don't realize this, but in order to collect on Social Security here in the United States, you have to have 40 credits. Now, each year has 4 credit units, so 40 credits equals 10 years of working experience. That does not need to be consistent, because that is a constant question. Does it need to be consistent? No, it does not need to be consistent. But over your working career, you need to have 10 years of contributions into the Social Security system in order to be eligible for Social Security. Also, Medicare has requirements. You need to have 40 credits or 10 years of experience in the US system in order to be eligible to receive Medicare. You want to pull the Social Security statement and make sure that person does have 10 years of working experience and is eligible for Social Security and is eligible for Medicare. I will also say this. You want to pull your Social Security statement and your pension statement at least annually, because I've seen pension statements with inaccurate information, and I've seen Social Security statements with inaccurate information. If there is a mistake, if there is an error, you want to catch it immediately and be able to correct it. You don't want to have to go back 20 years and try to prove that you have that year of earning a work experience. Odds are you don't have the documentation and you don't have any way that you can clearly prove that. So, while you're working, you need to be regularly pulling your statements for both pension and Social Security and making sure it is up to date. Another question that you should have about pension, or you should know at retirement, is does your pension include inflation index? Many pensions do, but some pensions don't. And this is going to become critical because I've seen pensions that were pretty decent sums of money really get corroded over time with inflation. A good example was 2022, 2023. We had that recent spike of inflation that nearly reached 10%. And if your pension had no inflation provision or a very, very modest inflation provision of 2%, you came out of that experience behind the 8 ball. Be sure to ask that question long before retirement. Does your pension include an inflation provision for retirees? Okay. Another thing you need to know at retirement, how will your pension be taxed at the state and federal level? Some of my clients who live across 2 states, they may live in, I don't know, New Jersey or New York, and they have a second home in North Carolina. They may end up finding their pensions taxed across 2 states, which may come as a very unpleasant surprise. Make sure you investigate how and where your pension will be taxed at the state and federal level. If you are planning to retire abroad, some countries do consider a pension income, like basic income, as if you were working. And so they may want to tax it in, Spain or Portugal, wherever you were living part-time, because you have part-time income. So you need to understand the taxation system for your pension. A big question I always have for my clients that have pensions, we go through this scenario: what if your pension ends? What if your pension ends? Like I said, I've had a client who actually had the pension go into default. There is a system that helps people whose pensions go into default, but it is not perfect. If your pension went belly up and that, you got notice that your last check is coming today and then there is no more money, would you be able to make it? And for a lot of people, the answer is probably no. But we have to at least ask the question and look at the specter of what happens if the pension does not exist in the future, because it is a possibility. If you're going to keep your pension, like for example, you decide you're not going to take the cash payout, you're going to take the lifetime payout, do you have a right to name beneficiaries? And if so, do you have to be married to the beneficiary? Some pensions only allow the spouse to be the beneficiaries. Some pensions, depending on the selection that you can make, you name someone outside the spouse as beneficiary of that pension. We need to look at that and see, does your prevention allow for beneficiaries, and when, who, and in what order we can name beneficiaries on your pension. And if you have a spouse, I strongly suggest you really need to work with an advisor or an accountant to make your pension selection, because a lot of the selection that you make, if you are going to take the pension, depends on your age, your spouse's age, whether you're male or female, and your life expectancy. It's complicated. It takes some fine points and some work to decide, but oftentimes a pension will give you the option of a spousal survival benefit, meaning if your spouse outlives you, they can continue to get a part of your pension. But let's say your spouse is 10 years older than you and in terrible health. Maybe it doesn't make sense to take that provision because you are taking lesser money. You are taking lesser money for giving your spouse the benefit of that option. And if your spouse is older and in bad health and probably won't outlive you, it doesn't make sense to take a diminished monthly check just to give that person the option of continuing on with the pension. So there you have it. Some things that you need to consider when thinking about a pension in retirement. If you found this information useful, please like, please share, and please subscribe.